So to get to a page like this, you're gonna wanna search up a stock. You can do AMD if you wanna follow along. So search up AMD in Robinhood and tap on trade, then trade options. It'll pull you up to, I think it says discover. Go up to the top and tap on any of the dates up there. And it'll take you to a page that looks very, very similar to this one. The numbers are gonna be different, but the layout itself is gonna look very similar. And what we're looking at here is 4 different call options. So there's a 49.5 call, there's a 49 call, 48.5 call, and a 48 call. So these are 4 separate call options. And if you have your phone open, you can scroll up and scroll down and you'll see there's a lot of different call options. These are not the only 4. There's a lot of other call options, but these are all that we need to learn and understand the basics of these options. What is a call? Well, it is a contract between a buyer and a seller. And in pretty much every example today, we are going to be the buyer of these call options. So we buy these call options from somebody. And we'll discuss how you do that in a little bit. But when you have this call option in your possession, it gives you the right to do something. It gives you the right, but not the obligation. In other words, you can, but you do not have to buy 100 shares of the underlying stock at a strike price. And I know that might sound a little confusing, so we'll break it down here. So AMD is our underlying stock. It's called the underlying when you're trading options on a certain stock. So it gives us the right to buy 100 shares, right? It gives us the right to buy 100 shares. But not only that, it gives us the right to buy 100 shares at a strike price. So let's say we have this $48 call here. $48 is not how much you pay for the call. $48 is this call's strike price. So if we have this call option in our possession, we can buy 100 shares of AMD for $48 each. Okay, it's not $48 for all 100 calls, it's $48 each. So great, we're buying 100 shares at the strike price. And this process of buying those 100 shares at the strike price is called exercising your call option. You're exercising your right to buy those 100 shares. So we have just exercised our call option. Now, this is pretty sick because the current trading price is $48.75. So we are buying shares for a cheaper price than everyone else is buying at. So if we wanted to, we could buy 100 shares at the strike price and immediately sell them back to the market for the current trading price, where it's just like trading stock. It's like you got in at $48 and now you want to get out at $48.75. You're going to make a profit. So we bought 100 shares at $48. Now we're going to sell 100 shares at $48.75. So if you think about it, we're making a 75-cent profit per share of those 100 shares. So we make a profit of $75. So this process of exercising your call option and making a profit is the case for any call option whose strike price is less than the current share price. If you think about it, if your call option has a strike price lower than the share price, you're buying at a cheaper price than everybody else is. So you can buy at a cheaper price and sell at a higher one. So if it has a strike price below the share price, you can make a profit. And the lower the strike price is relative to the share price, the larger that profit is going to be. So call options whose strike price are lower than the current share price, where if you exercise, you would make a profit. Those options are called, those options are called in the money options. Call options, specifically regarding calls. We'll get to puts here in a little bit, but we're going to talk about calls first. So these are in the money call options. And in fact, everything lower down below that would also be in the money. But what about options where the strike price is the share price? So let's say there's a call. I'm not saying it's possible, but there's a call that has a strike price of $48.75. Well, you buy 100 at $48.75 and you sell immediately all those 100 at $48.75. You've gained nothing, you've lost nothing. So you just break even. So those kind of call options, these ones right here, are called at the money or ATM. You'll see it abbreviated. And how about these ones that are above the share price? You can see the $49 is higher than $48.75. Well, you're buying 100 shares at a higher price than you can buy out at the market. Why would you want to do that? You just buy it at the market. It's cheaper. So if you exercised it, you'd buy at 49, sell at 48.75, you'd actually be at a loss. So you never exercise this kind of call option. And this is the case for any call option whose strike price is higher than the current share price. You don't want to buy at a higher price than the market's already trading at. That's stupid. You lose money. So these options that you would most certainly never exercise are called out of the money options, out of the money. So OTM. And you can see I kind of color coded it here. In the money, they're awesome, super cool. At the money, who cares? Out of the money, no good, garbage. Okay, so now we understand that a call in the money call option is great. You can buy 100 shares at the strike, sell at the current trading price, you make a profit. All right, so I'm just gonna highlight this a different color here. We're gonna keep looking at this $48 call. So how do we get these call options in our possession? Well, you have to actually buy them from the seller. You have to buy the right to exercise. And you can see how much you have to pay down here. If you're looking at this $48 call, you can see, or 48 strike call, we can see that it says $2.74. But that does not mean that you're paying $2.74 to buy this call option. Not at all. It is $2.74 per share of the 100 shares that the contract controls. So if you remember, you have the right to exercise 100 shares, you're paying $2.74 per share of those 100 shares for that right. So more realistically, just cutting through the jargon there, more realistically, you're paying $274 for that call option. So if you want this call option in your portfolio, the ability to exercise at $48, you have to pay $274 to get it in your portfolio. We pay a debit. It's called paying a debit. When you pay something out of your account, it's always a debit. When you receive funds into your account, it's a credit. So now we have this $48 call in our possession, which is fantastic. This $274 is going to change. It will not stay constant. You can kind of see how it will change with the other call contracts that are less in the money. So this one's a little less in the money. It's $247 total. This one's out of the money. It's $224, $201. So you can kind of see the pattern. The further out of the money or the less in the money you are, the cheaper those call options are going to be. And this is because the further in the money you are, the bigger profit you can exercise for. So they're going to be worth more. The less in the money they are, the cheaper they're going to be because you can either exercise for a smaller profit or no profit at all. So as the share price moves around, making these call options less or more in the money, the price right here is going to shift around, just like a share would. If you're trading AMD shares, it's going to go up and down, and you're going to buy at one price and sell at another. So in this case, let's say that we bought this $48 call for $274, but then all of a sudden this stock price, and we'll change it to blue to keep it kind of consistent there. This stock price jumps up to, let's say, even further than that. Let's say it jumps all the way up to $50. All right, that's a current trading price. This 274 is not going to be 274 anymore. It's going to change. You will not see it like that. It will not be 274. It'll change to, and I'm kind of making up a number here, it'll change to something like, let's say $400. So that now people are buying and selling this call option for $400, and you can sell this call option for $400. So if you paid a debit at $274, but now you can sell this call option back to the market for a credit of $400. You paid $274, but you received $400. That's going to give you a total profit of $126, if I'm doing that math right. So you can see that even though we have the ability to exercise, we didn't. And we can buy and sell options for the price that they're worth and make a profit or make a loss. You never have to even exercise it. And there's a real good reason why you would never want to really exercise them anyway. And we'll get into that in just a second. Let's go ahead and look at this $48 call today. I like the $48 call because it's in the money. So we are going to be looking at this $2.74 of premium. This premium, we've talked about how it makes sense. This option is more valuable because you can exercise it for a larger profit as compared to like the 48.5 call or the 49 call. But we can actually tear apart this premium and figure out exactly why it's priced like this. We're not going to look at the formula like the Black-Scholes model that would very specifically mathematically describe why it's priced like this, but we're going to look at it from a very conceptual standpoint. And this conceptual perspective on how premium is priced is very, very useful when you're actually trading options. So this is not just some theory. It's not just theory. We're not just studying theory here. It is very practical, I promise you. All right, let's take a look at this $2.74. Remember, that's per share, $2.74. This can be divvied up into two different categories. One is called intrinsic value. The other is called extrinsic value. Intrinsic value is a portion of the premium, and it is just whatever profit you can exercise it for. So we are looking at this $48 call, right? We buy 100 shares at 48. When we exercise, we sell at 48.75. We make a $75 profit, just like we said earlier in the last section. Okay, so we can say that 75 cents of premium is due to intrinsic value, which is how much profit you make when you exercise the option. So 75 cents is intrinsic value for this call option, this 48 strike call. And we'll write it here. And how about extrinsic value? Well, this is whatever's left over. So we have 75 cents for intrinsic value. So we subtract that from 274, and we are going to have $1.99 worth of extrinsic value. And this extrinsic value, what that is value given to the option because there's time left to maturity. In other words, there's time left to expiration. There's time for this option, even if it's out of the money or in the money, there's time left for it to get in the money or for it to get deeper in the money. Remember, the more in the money it is, the more valuable it is. So there's some value given to this call option because there's more time left. It doesn't have to stay it doesn't have to be, $1.75 in the money. It could be much, much deeper by the time we reach January 31st, theoretically. The share price could jump up to $55 and then it's way in the money. So there's some value that's given to it based on time to maturity. In addition to this extrinsic value is not just time to maturity, but it's also implied volatility. And I'm just going to briefly gloss over it. We'll get to it more in a second what implied volatility is, but you can think of it as the volatility of the underlying stock. Does it bounce around a lot or is it very calm? If it bounces around a lot, that's great for call options because your loss is limited to the amount you paid for it, but your upside is uncapped. It can theoretically go up forever. So volatility is very good for options. So that volatility of the underlying stock is also priced into options. You can think of implied volatility. Volatility is only important if there's time for that volatility to act. Okay, so hopefully you can see how that's kind of combined together. So this is extrinsic value. So let's pop back over to intrinsic value here. This 75 cents that is intrinsic value is going to change. And it makes sense why it would change because this call option's not going to always be only $1.75. It might be more, it might be less. So it'll change. It could be, it's just whatever you can exercise it for, whatever profit you can exercise it for. And that number is going to change. Out of the money options, you cannot exercise for a profit. So they have no intrinsic value. And I'll write that here. And intrinsic value is IV. A lot of people use IV for implied volatility, but that's not really correct. Out of the money options have no IV. They do not. No intrinsic value at all because you cannot exercise for a profit. So this part of the premium is going to fluctuate. This premium over here is also going to fluctuate based on if implied volatility increases or decreases. And we'll get to that more in a moment again. But think about it as if implied volatility increases, extrinsic value increases. They are positively correlated. If implied volatility decreases, extrinsic value decreases. And again, we'll get into implied volatility in here in a second. I just have to mention it here. Time to maturity, on the other hand, has a different effect on extrinsic value. And we're going to say extrinsic value decays as time passes. So as time passes, this number is going to shrink. Literally every day. You pay to play every day. You buy in at 274 and ignoring implied volatility, if the stock trades sideways, you're going to lose money. If the stock trades sideways, for a little bit, this looks going to drop down to 198, which means this is going to be worth 273 and you're going to lose $1. Maybe a little bit later, it drops down to 197. This will just keep bleeding off all the way up until expiration date, at which point you've either got to make it or break it. You're either in the money or you're not. And this process is called, call it time decay. It's also called theta decay, which we'll touch on here in a moment. But just know that when you buy options, the stock can trade sideways and you're losing money. Okay, so just kind of recapping what we have here. Part of this premium is literally whatever profit you could exercise for. So $75 worth of that $274 you pay is the amount you could exercise for. The extra $199 that's left over is due to time to maturity and implied volatility as a function of each other. The more time you have till expiration, the more time you have for that volatility to take effect, the more valuable your option is going to be. So both time to maturity and implied volatility are good for options. You want more time. They're going to be worth more. It also means they're going to be more expensive. So if you flip between January 24th, February 7th, February 14th, you'll see that these numbers increase the further out your expiration is because there's more time to maturity. You can actually see what we're talking about be shown on your app when you select a further out application. So they're going to be more expensive because there's more time for them to get in the money, which is a good thing. But that means there's also more money to bleed off. So if you bought an out of the money option with a far out expiration date, that will just bleed off. If you never get in the money, it'll bleed off to zero on expiration date. You're done. There's no money left. But of course, that's with call options, that's the max you could lose. You can never lose more than the amount of money you put into it. So at expiration day, nothing terrible happens. The worst thing that can happen is that it expires worthless and you don't have any money left. If it expires in the money and you have the capital set aside, it'll exercise automatically. So those are like the two options you can think of happening. This is why you would never exercise this $48 call, or very rarely would you exercise before expiration day, when you have all this extrinsic value left. You may get up to expiration day and all this extrinsic value is gone and you have intrinsic, at which point you might as well just sell the option, but you could exercise it as well if you just have intrinsic value left on the last day of expiration. Because if you exercise, you'll make $75, or you could just sell this option, which is now worth $75, and make $75. There's really no difference. But let's go ahead and, just so you get the idea in your head, let's go ahead and exercise this option. So we have this $48 call. We exercise it. We make our intrinsic value. We make $75 because they're equal to each other. This $75 from this $75 profit you make from exercising is built into the premium. And we call that part of premium intrinsic value. So they have to be equal. So $75 when you exercise it. However, you lose the extrinsic value. You lose $199. Once you exercise, there's no more time. You just gave up all your time. If you exercise now and there's still a few weeks left until January 31st, you gave up all that time. So you give up extrinsic value. There is no time to maturity as a function of implied volatility because there's no more time for time to maturity. The contract's gone. You've used up your right. It's disappeared. So extrinsic value disappears. So you lose $199. So if you gain 75 but lose 199, you're going to be at a loss of what? 75 minus 199. You are going to be at a loss of, we'll do it in parentheses, 124. This is why you can't just buy the $48 call and exercise it immediately. You would be at a loss. So why exercise it? You wouldn't. You'd only ever just sell the contract back to somebody else. Don't exercise it. You give up all that extrinsic value. There are certain examples where you will exercise. They're so rare that it's not worth talking about right now. Summary time, boys and girls. So when you buy a call option, you are paying this premium right here, this $2.74 per share. So you're paying $274 to buy this option. That premium of $2.74 can be divvied up into two separate categories. One is an intrinsic value. The other is extrinsic value. Intrinsic value is whatever profit you would get when you exercise the option. If you have a ticket that says get $10, use at the snap of your fingers and get $10, that ticket is going to be worth $10. So that's essentially what's happening here. This call option is a ticket to at least $75. So it's going to be built into the price of that call option. So whatever profit you get when you exercise. Without the money options, there is no intrinsic value because you cannot exercise it for a profit. Extrinsic value is a premium built into a call option based on time to maturity and implied volatility as a function of each other. The more time you have till expiration, the more valuable your call option is going to be because it has more time to get more in the money. And in volatility is going to determine how likely that potential is that it gets deep in the money. If there's low volatility, it's less potential, so the option is not going to be worth as much. If there's higher volatility and there's more time, there's a higher likelihood it's going to swing deeper in the money. So it's going to be represented as a more expensive call option. Most of the time, you would not want to exercise your call option because when you exercise, you do technically give up all of your premium, but you also make $75 just by exercising it. So really all you're giving up is extrinsic value. And you don't want to throw that money in the garbage. That would just be throwing it at the seller's pocket. You don't want to throw it away. So you almost would never exercise. But exercising options is where this premium comes from. The ability to exercise is what drives the value behind call options. Oh, mamma mia. And lastly, while we're here, I want to touch on where you see to break even percentage. This just means the stock price has to increase by 4.08% for you to break even. Here's the dealio. I just went on a rant that was just too much. It's too much information, I think. But I was talking about the to break even percentage. And I'm just going to tell you what it is. If you want to learn more about it, I'm throwing a video up in the corner that I went into great detail about it. What it is, go away. Thank you. What it is the percentage the stock price has to move up because you have calls, you're betting on the stock going up for you to break even by expiration date. When you buy this call, you are at break even, essentially. You buy at 274, you could theoretically, we're kind of glossing over some things, but you could theoretically just sell for 274. And so you're at break even. But as time goes on, the extrinsic value decays off and that option becomes less and less valuable. You better hope the stock price goes up so that the value of the option increases to counteract this extrinsic value decaying off. Okay, so today your break even's right where you bought in. On expiration day, your break even is going to be 4.08% in the upwards direction, which is going to be the stock price of $50.74. I don't want to go any more into that because let's take a look at why volatility is good for options and how you can use it when you're trading. So let's pretend we're looking at a stock chart here. Okay, it's wiggling around, it's doing its thing. And let's say we're just kind of breaking the rules a little bit here, but let's say at this point we would be at our max loss, or our contract would be worth $1. It's never going to be worth less than $1 before expiration. You know, at expiration, if it's out of the money, it'll expire worthless. Definitely want to sell before expiration. It'll never be worth 0 before expiration. So let's say we hit 0.01, so it's worth $1. And we'll say that this area, the white area, is low volatility. And all of a sudden, volatility really picks up and we get some massive swings, right? Huge swings all over the place. Well, this is good for options because your losses are capped. Even though volatility increases, once you hit this point right here, your option's gonna be worth 0.1, it's gonna be worth $1. It's gonna be worth $1. Down here, what's it worth? It's worth $1. Down here, it's worth $1. If the stock went down all the way to like 1 cent, it would be worth $1. Okay, it's never worth 0 until it expires. But what about when it goes up? So let's say at this point, let's say when we bought it right, let's change our color here. Let's say when we bought it right here, it was worth $250. When it swings up here, it'll be worth $400. When it swings up here, it'll be worth $800. When it swings up here, it's worth a whopping $1,600. So even though volatility increases and the potential for things to go down increases, once it hits this point, anywhere below that, it doesn't matter. It's going to be worth $1. However, when it goes up to the upside, the further up it goes, the better. Your potential profits are uncapped. So that's why volatility is a good thing. And so when people expect stocks to be volatile, options are going to be more expensive. That's essentially, in the simple terms, what implied volatility is and why it is good for options. And it is also worth noting that implied volatility is extracted from options premiums, something like this. It'll have big drops at certain points with earnings plays, which is why you never buy options on earnings. Do not buy options on earnings. Please don't. Implied volatility collapses after earnings, and so does your options premium. So never, ever buy options as an earnings bet. I'm telling you as your mom right now, don't do it. You're going to lose your money. So it changes over time. So your options premium is going to change over time, which means that if you buy an option when implied volatility is down here, and then you hold it, and then you hold it and hold it and hold it up to this point, till you're right there, everything else held constant, you're going to make money because maybe you bought this option at $2.70 worth of premium, so $270. Stock trades sideways. You don't have that much time decay. It hasn't been that long, so that extrinsic value has not decayed off really, just hypothetically. Up here, it might be worth $290 in premiums terms, so $290. So you would make $20 just from implied volatility increase. Option statistics that are very, very important to trading. So to get to this page, which is a list of statistics that pertains to a specific call option, what you're going to want to do is you're going to select a specific call option. So you'll tap on it. And then towards the left side, you'll see a bid and an ask price. And they almost look like they're a hyperlink. They're kind of highlighted a color. So you're going to tap on those guys and it'll bring up these statistics. And so we're going to break these down for you. And they're very important for trading. So we're going to break down most of them. We're going to ignore chance of profit and implied volatility. You just don't really need to know that right now. Plus, we've already covered implied volatility. Implied volatility pertains to individual options, but you can really just think of it as almost averaged. So implied volatility, like we said, is extracted from options prices. And so you can see the implied volatility that is implied by this options price. And each option is going to vary a little bit, but you can think of it as just applying to the overall stock, almost like averaging all of the options implied volatility. So you don't need to get into the details of that. Okay, so we're going to start off by looking at the bid and the ask up at the top here. The bid represents the buyers. The ask represents the sellers. Sellers want to sell at a higher price. Buyers want to buy at a lower price. It makes sense, right? Just intuitively. And you can see that represented here where this bid price is $224 and this ask price is $227. So this represents where people are buying and selling at. And you can see how many people are buying and selling at because you can see the number right next to it. So there are 58 orders at the price of $2.24. Those are buy orders. There are 12 orders at the price of $2.27. Those are sell orders. That difference between the bid and the ask, that difference there, the really 3-cent difference in premium, that is called the bid-ask spread. So a seller has to either meet a buyer at the bid price, because that's where people are buying at, or the buyer has to meet someone at the ask price, or maybe they meet somewhere in the middle. But regardless, someone's giving up some money. So if I want to buy this option immediately, I have to buy at the ask price because that's where people are selling at. That means I'm buying for $2.27. And that bid-ask spread, that 3 cents, that goes to the exchange. The people who are meeting these buyers and sellers together get the bid-ask spread as compensation for uniting those two parties. So that goes to the exchange. So either the buyer meets the person at the ask price, the ask meets the person at the bid price, so they give up 3 cents and those 3 cents go to the exchange, or they meet somewhere in the middle. So you could, to buy and exit immediately, you would have to buy at the ask and sell at the bid, and you would lose 3 cents overall because you're paying $2.27 and then selling for $2.24. You're selling for 3 cents less, and in premium terms, that's $3. So you would give up $3 to get in and out of this trade immediately. But these two, this happy little couple here, can meet somewhere in the middle. So for example, maybe the buyer puts in a order for $2.26. Well, the seller might be willing to move from $2.27 down to $2.26. And then all of a sudden you have this match together where someone's buying at a price and someone's willing to meet them at that price. And the seller is giving up 1 cent. This person is selling at a cheaper price. And the buyer here is giving up 2 cents. Because the buying price, the bid price is $2.24. So altogether, they give up 3 cents. And that 3 cents, like I said, goes to the exchange. Sorry, it's white on white. So let's get rid of this a little bit. So really all you need to think about is the closer you are to the ask price when you're setting a limit order to buy an option, the closer you are to the ask price, the more likely it's going to be filled because then you're paying a higher price for it. Sellers don't have to meet you at such a low price. Don't go trying to sell at the ask price. You're going to have quite a hard time doing that. You might set somewhere in the middle. And you can see what price is in the middle because it's called the mark price. And that is listed right here. And that's going to be the price that Robinhood displays on all of their options. So sometimes you might buy an option where the bid ask is really big. And when bid asks are very wide, they tend to jump around a lot. And Robinhood will continually show the mid price. So even if there's like no buyers, so let's say there's no buyers at all, it's going to be 0.00 on the bid side. And then on the ask, we'll write bid here. On the ask side, there might be one seller, but they're selling at a ridiculous price of like $2, $200. Well, Robinhood, even though there's no buyers, Robinhood is going to show the price as $100. And so maybe at one point your option was worth, it was showing the mark price at like 50 cents because the seller was selling at 100. But now a seller's selling at 200 and there's no one buying. It's going to show 100 in the middle. On the Robinhood platform, it's going to say you made $50. If that's a little confusing, that's okay. I'm just saying the bid ask is going to jump around, and sometimes the mark price, which is not really a realistic price all the time, is going to be the price that Robinhood shows. So you might see an instantaneous profit, but it's not real because you still have to sell at the bid and there's no buyers there anyway. So the mark price is in between the bid and the ask, and it is what Robinhood shows as the price for the option. Even though realistically you may not be buying at that price or selling at that price, you might be buying closer to the ask or selling closer to the bid. The high and low, that's the highest price for the day, and that's the lowest price for the day. The volume equals number of contracts traded. The higher the volume, the better, because if there's people buying and selling throughout the day, you want to be able to buy and sell with them. You want to maybe be able to get in and out of a trade quickly. So if there's higher volume, like this kind of volume is good, 1,455, that's good volume. If there's higher volume, you're going to be able to have people that are willing to buy from you when you want to sell an option and people willing to sell to you when you want to buy an option. If volume is very low, there may not be many people wanting to buy and sell options. You might have a hard time getting in and out of a trade. Open interest, which we're just going to call OI. And you can see that open interest is right here. Open interest is number of contracts open. So this is saying currently there are 4,114 of this exact call in existence. And they will go in and out of existence as a buyer and seller agree to create a contract, and then a buyer and seller swap sides and destroy that contract. This open interest is going to fluctuate. It's going to grow and shrink. The more open interest there is, it's going to be probably going to be higher volume. And the higher volume there is, the tighter the bid ask is going to be. So that's why it's really nice to be trading options when they have high volume, because that people buying and selling a lot is going to push that bid ask price closer and closer together. And when that's closer and closer together, you're giving up less to get in the trade. Because remember, you have to buy at the ask and sell at the bid if people aren't willing to meet you in the middle. So a tight bid ask like this, which is like 3 pennies, is great. It's not that big of a deal, giving up $3 if you have to get in and out very quickly. But if this bid ask is very wide, maybe 50 cents or $1 wide, because of the volume is so low, you're giving up $50 to $100 to get in and out of the trade quickly. So you always want to check this when you're going to buy an option. You want to make sure that the bid and the ask is tight. That's a real biggest part of all of what I've said so far is look at the bid ask. Is it tight? Are you willing to give up that much money if you have to get in and get out quickly? Think about it. All right, let's get rid of some of this. Okay, now we're moving down to the Greeks. And the Greeks are what is affecting the price of the options. And we've covered basically all of this as far as what you need to know. But this tells you how much certain things are affecting the price of the option. And it all makes sense here in just 2 seconds. We're just going to write it out here. So delta. This represents how much your options premium is going to change given $1 change in the underlying. So if this stock, if AMD goes up $1, that means that the value of your contract is going to increase by 50 cents. So you are going to make $50 if AMD goes up $1. Now you see how that's a lot of leverage. And that's the appeal of options, that they can give you a lot of leverage. This is almost like having, excluding other things, it's almost like having 50 shares of AMD, but you're only paying $227 for it. So that's leverage. And this kind of leverage might not be suitable for you. You may not be willing to lose $50 if AMD goes down $1. Okay, so it's up or down. It's positively correlated, which is why this number is positive. It's how much premium changes with a $1 move in the underlying. AMD goes up $1, you make $50. AMD goes down $1, you lose $50. Gamma, which we're not going to get into too much today, is how much delta changes giving a $1 move in the underlying. So delta is not constant. It does not say it stay at this 50 cents, which is why if you buy a further out of the money or further in the money option, they're going to have different deltas. In fact, those deltas are going to change between 0 and 1. So the further in the money you are, the higher your delta, the more leverage you have. However, if you buy maybe an in the money option for $100, but you buy 2 out of the money options for $100, so those out of the money options are worth 50 cents each in premiums terms. Those 2 out of the money options are going to give you an overall higher delta. So in other words, if you buy a couple out of the money options, they're going to give you more leverage than a single in the money option that's worth the same in premium. So just kind of writing it out as an example here, you might have out of the money options. They're worth 50 cents each. You're going to buy 2 of them. So you've paid $1 in premium. In the money, they might be worth $1 each. So you're going to buy 1 of them. So you're paying $1 of premium. However, the delta of each of these, just for example, is 0.3. The delta for each of these is equal to 0.5. However, you bought 2 of these, you bought 1 of these. So your overall delta is 0.6. Your overall delta here is 0.5. So even though you paid the exact same amount, if you buy 2 out of the money options, you're going to have more leverage than buying 1 out of the money option for the same price. So gamma, how much delta changes given a $1 move up or down in the underlying? And gamma will change as well. But we're not going to get into that too much. Theta is how much you pay to play every day. So this is, and it's negative. So that means as each day passes, you are losing 7 cents or, rounding up 8 cents of premium every day. And that is actually going to increase. So every day, because of that extrinsic value that evaporates off, that value that's based on time to maturity as a function of implied volatility, that premium is going to start evaporating off as time goes on. And you can see exactly how fast it evaporates off right here in theta. This is called theta decay. So you lose, in real terms, $7 every day. And this will ramp up in speed as you get closer to expiration. In fact, the curve of, if we could graph it out here, let's say you bought in here and this is the premium you paid, it's $2. And right here is expiration day. The value of your option is going to look something like this, where initially, when you have a lot of time left to expiration, the theta decay is going to not have very much effect on the value of your option. It's going to, stay relatively flat, might bleed off a little bit. But as time gets closer and closer to expiration, it's going to really, really ramp up. And you can see because the expiration of this AMD option I have selected expires in like a week. So you can see how as each day passes, a large portion, like $7 of that bid, that $227 that you would pay for now evaporates every day. And that's going to ramp up until expiration day. And then all that extrinsic value, that value based on time to maturity and implied volatility is gone. And your option's either in the money or it's not. It's either worth something or it's worth nothing. If it's out of the money, it'll expire worthless. So when you combine buying out of the money options with a near expiration, you are giving yourself a lot of leverage. They're very cheap, so you can buy a lot of them, and you're giving yourself a lot of leverage if things move big fast. But if they don't move big fast, all of a sudden you're going to be down a lot of money because that extrinsic value, which is all that constitutes out of the money options, is going to evaporate very, 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 very fast towards the end of its lifespan. Okay, so delta, how much the options premium changes given a $1 move up or down in the underlying stock. Gamma, how much delta changes given that same $1 move. So delta changes by a factor of gamma. The more in the money, as with a call option, the more closer to 1 delta is going to be. The more out of the money, the closer to 0 it's going to be. With puts, you'll see that it's going to be -1 and 0 because with puts, you're going to be betting on the stock going down. So when you're betting on the stock going down, it's negatively correlated. So if the, if delta is -0.5 for a put, that means if the stock goes down, you are going to make $50. If the stock goes up, you are going to lose $50. So they're inversely correlated. But we'll touch on puts more in a minute. Once you get calls down, puts is easy, I promise you. Vega is how much your premium is going to change based on a 1% move in implied volatility. So if implied volatility increases, you are going to make $4. So Vega, how much premium changes given a 1% move in the implied volatility? So almost like how delta is to the stock price, Vega is to implied volatility. So you can see there's a positive correlation, and that's going to be positive for both calls and puts. Implied volatility is both good for both calls and puts. Rho is a tiny little baby guy that barely moves the needle. It is, Rho has to do with changes in interest rates. When interest rates change, they're going to affect the value of your options. But it's so insignificant and not worth even bothering with that I'm not going to go into it. So don't worry about Rho. So in this section, we're going to describe a lot of what we've... On the left here, we have a premium diagram. It's a diagram of premium. It's not like a very fancy diagram. And on the right, we have a profit loss diagram. So on the left side, this y-axis is going to be premium. And we're talking about calls. So it's going to be call premium, and that's going to be denoted as C. So we have call premium on the y-axis. And then on the x-axis, we have stock price. And we're going to denote that as S sub 0. So essentially, this blue hockey stick looking guy is your call premium given different stock prices. So basically, any stock price below this point, your call premium is 0. There's no call premium. You're at your max loss. Once you hit whatever this stock price is, you start making money and your call premium goes up such that maybe right here it's $1. Maybe up here it's something like $2. Okay, and we're going to leave one of those there because we'll need it here in a minute. And this is all on, I guess I should say, this is all on expiration day. Every bit of this is all at expiration. So we're looking at, if you remember, this is after all that extrinsic value is gone. So we are looking at intrinsic value. So what is the intrinsic value of this option? What is the value of this option on expiration day, given different stock prices? And on expiration day, if the stock price is below your strike price, that means your call is out of the money. You can't exercise it for a profit. It's worth nothing. It has no intrinsic value. It's out of the money. You exercise it, you lose money. So there is no intrinsic value. So when it's below your strike price, that means your call's out of the money. So it's going to be worth nothing on expiration day. There's no intrinsic value. So we're going to choose a strike. We'll say strike equals 20. So that means that this stock price right here is $20. And after that point, you start making money. And if we're talking about intrinsic value, we know exactly what the stock price would be when you're making $1 in premium. It would be 21. Because if you're $1 in the money, you exercise it, you would make $100, $1 gain per share of those 100 shares. So if you make $100 when you exercise it, that means that the call must be worth $1 in premiums terms. So we know exactly what the stock price is when the call option is worth $1 on expiration day. So this is all a lot of what we've been talking about, just kind of drawn out. But any day prior to this, and this is at expiration, remember, any day prior to this, it's not going to look like this hockey stick right here. It's going to look a lot different. So let's say maybe a few months back, the premium's going to look something like this. So that instead of it being worth $1 when it's at 21, when the stock price is at 21, it's going to be worth something like, we'll kind of estimate here, we'll say it's something like $4. We'll kind of scribble this out now, bring it up here. So strike is 20. So there's all that extra value given to this call option based on time to maturity and implied volatility. Whoa. And we call that extrinsic value. So the difference between these two is that extrinsic value, which is $3. So it has $1 of intrinsic value because that's what you can exercise it for. And it's now worth $4 at that stock price when it's 2 months earlier. So there must be $3 worth of value based on time to maturity and implied volatility. So basically, any of the area underneath this curve is extrinsic value. It is this value given to the option based on time to maturity and implied volatility, which will slowly decay off. So over time, as time passes and time goes on, this curve is not going to stay the same. It's going to slowly start shrinking down. So like maybe after another month, it's going to be right there. And you'll see that your call options value is going to decrease. So maybe now it's at 350. We'll get rid of that just to keep things nice and simple. And then maybe a little bit later, it's looking something like this until on the last day of expiration, it just is that blue hockey stick graph. All that extrinsic value is gone. You can either exercise it for a profit or you can't. So this process of the options premium decaying away, the extrinsic value of the options premium decaying away until all that is left is intrinsic value, the blue hockey stick. That process is called convergence. It's going to shift based on implied volatility like we discussed. So it might shrink down if implied volatility decreases, and you'll see that that causes a decrease in your options premiums. Now it might be $3 down there. If implied volatility increases, then maybe this line will increase like that. And now it's going to be worth more than it would otherwise. So maybe it's worth something like $5. So that yellow line is going to bow in and out based on expansion and contraction of implied volatility, and it's going to shrink overall as time passes inwards until it becomes that blue hockey stick, and that process is called convergence. Got that out of the way. So that's basically the concept we've been talking about, just kind of drawn out. So over here on the right, we have a little bit of a different diagram that you see often when you're learning new option strategies, like I said before. On the y-axis, instead of having the call premium, you have your profit or loss. So this blue hockey stick is the exact same over here, except for instead of looking at call premium, we're looking at how much money you've made and how much money you've lost. So we're going to say that when you bought this call, we're going to say the call premium was $1. So you paid $100 for this call. In addition, like we said, our strike price is 20. So we're going to put 20 right here. If you're out of the money on expiration day, you have lost everything. If you're in the money, there's a certain area where you make less of a loss, and then you start making a profit right over here. Ooh. So if you're out of the money on expiration day, your max loss is going to be whatever you paid for that option. And you paid $100. So you lose $100 if you're below your strike. Now, right here in the middle, right at the x-axis, it's not good nor bad. You are at your break even. You neither made money nor lost money. And you can see that because your profit and loss, as it's graphed out, crosses the x-axis right there. So this is your break even. Right there's your break even. You've neither made money nor you lost money. And I know exactly what the break even is because the break even is equal to your strike plus the premium you paid. Because let's think about it. It's kind of not super intuitive, but let's think about it. If we are at $20 and we exercise that option, what's going to happen? Well, we're going to buy 100 at 20, right? We're going to sell 100 at 20 because that's the current share price. We neither make a gain nor a loss. We're at 0, but we give up the call premium we paid. When you exercise that option, the value of your premium goes to the seller. You don't get to keep that money. So you get 0, but you also lose the money you put into it. So you're at a $100 loss. Okay, so let's think about that then. How do we make up that $100? Well, we have to hope that this gets $1 in the money, because think about it. If we can exercise at $20, but if the current share price is 21, we can sell for $21 each. And we are going to make a $100 profit. So if we make a $100 profit, but we give up the call premium, it goes to the option seller when we exercise, then that means that we are going to lose 100 and we are at break even. So we're talking about this in the context of if you exercise or not, but you have to also think about the value of your contract on expiration day is whatever you could exercise it for. So your break even right here at $21 that's going to be the value of your call contract. It's going to be how much you put into it. So if you paid $1 for this call contract at $21 on expiration day, that's your break-even price. You are going to neither have made any money nor lost any money. You would sell it for just break-even. You could also exercise it for break-even, but what's the point? You might as well just sell it. And this is where the math on expiration day is very easy. If the stock price is 22, we draw a line up here, we draw another line over here, we've made $1 in premium. I guess I make it green, huh? We've made $1 in premium. So here we are looking at a list of puts on AMD. Notice I have buy puts selected. And once you buy a put or a call, you can sell by choosing sell, call, or put and selecting the put that you bought. But it's easier just to do it from your home menu. It's also possible to sell puts and calls when you don't even already own them. And that's creating a contract. You're creating a contract and selling it to somebody. But that's a whole nother deal, and you have to have quite a bit of money in your account to do that. But it is part of doing spreads where you actually don't need that much money in your account. So check out those videos that I have. They'll make you a better trader and you'll make more money if you learn them. So we have buy put selected. We're looking at 4 puts here. 1, 2, 3, 4. Notice the similarities. They do have strike prices, 50, 49, 48, 47. The only difference is, if you remember, calls give you the right but not the obligation to buy 100 shares at the strike price. The only difference is with puts, let me write that out actually. So this is for calls. They give you the right to buy 100 shares at the strike price. But for puts, this gives you the right to sell 100 shares at the strike price. Now you could own these shares already, or you may not own those shares already. So let's take a look at a put here. So we are going to take a look at this 50 strike put. And remember, the current share price is down here at 48.42. So if we can sell 100 shares for $50 each, and then we could buy those, so we'd be selling short. If you do not have the shares already, you would borrow those 100 shares automatically from your broker, and you would sell them, and then hope to buy them back at a cheaper price. So if you exercise this put option, you would sell 100 shares at the strike price. And if you don't own them, you're borrowing those shares from your broker, which is called selling short. But if you already own the shares, it's the same deal. Those shares just disappear from your account. So you are now, let's say you don't have them, you're short 100 shares for $50 each, and you can buy back those 100 shares immediately at 48.42. And the money you're going to keep is going to be the difference between these two times 100, which is what? $1.58. Remember, that's in premiums terms, so you actually make $158. So in that sense, these, it's a little different than before. These ones are in the money. This is still at the money. These guys are out of the money. So it's just flipped. When you're in the money, you hope the stock price is going down. It's below your current strike price. You're out of the money if the stock price goes up. So it's just flipped. You're betting on the stock price going down. You'll still see, if you look at the options Greeks, that theta will be negative. You'll see that delta will be negative. Remember, for calls, theta is also negative. For calls, delta is not negative. It's positively correlated, because with a call, you're betting on the stock going up. So as the stock goes up, the premium increases. So that's a positive correlation. And one other small difference that is worth noting is that their break even is below their strike price, because you're betting on the stock price going down. So instead of your break even being strike plus your call premium, it's going to be strike minus your put premium. Because if you think about it, when you exercise, you're giving up that premium that you paid, and you better hope the stock price has gone down enough to make up for that loss of your premium that you paid when you exercise. So with puts, just think of it, it's the same as calls, only difference is you're betting on the stock going down.